Hi guys, we're going to go with section 11.2 today, and we're dealing with homeowners insurance. If you have a mortgage on your house, you're required to have homeowners insurance. Think of this a lot like our car insurance. If we had a loan on our car, we had to have insurance. The same thing applies with our house. If we have a mortgage on it where we're still paying for it and don't own it outright, we have to have insurance on it. And the insurance company requires that we have insurance on it that is equal or greater to the principal of our loan on it. Now, even if you were to have this house completely paid off, it still is a good idea to have insurance on your house, because what happens if there's a fire or a storm or some other damage that happens to your house? Your house is a large value to you, and you can't pay off damage to it right away. And so it's nice to have our insurance to help cover that damage that happens. So it is good an idea to have insurance. Okay, we're going to talk about homeowner insurance, and there's two types of coverage that we have. The first one is property damage coverage. This pays for the house and all the personal effects in it. So if you have like a fire or something like that, your property damage is what covers you under your homeowner's insurance. The other type of coverage we have under with homeowners is our liability coverage, and the liability covers any medical expenses that might happen. Let's say you fall down the steps in your house, it would pay for that. Or if you have people over and they slip and fall on your icy porch, this insurance covers that. So it's damage that might happen to somebody's property, like their car if they're visiting your place or something and a tree falls on it. This is the coverage that would cover that instance. Okay, so now that we have an idea of homeowners insurance, we have to get comfortable here with the chart that we have in our book. Okay, this is going to be your lifeline. This is table 11.1, and you have it in your book on page 406. Now, we're going to think of, remember how we did car insurance, how we had to flip back and forth with all the charts? With homeowners insurance, we only have this one page to worry about. And this chart here basically covers just our basic premium. This stuff right here, these 5 points at the bottom, are the important things. And this is what you're going to have to really pay attention to and look at and know how to work with it for each of our examples that we do. Okay, now to understand insurance, we just need to get into it and do some different examples. So we're going to take a look here. Oh, before we do that, let's look at the things that can affect our premium. Okay, so in that chart we have our basic of premium, and this is some of the things that affect it. So the type of construction: is your house frame constructed, and does it have wood siding or vinyl, or is it frame construction with a brick veneer? That can change the value of your house. Also, do you have a good credit rating? Also, your location of where you live. Do you live in an earthquake zone? Are you in a flooding area or an area that experiences wildfires? That can all affect the rate of your loan. Also, the stuff that you have in your house can affect the cost of it. It's an additional charge to it, okay? So think about it when we did car insurance, how if you were an 18-year-old boy, how that affected things, or whether you went to driver's training. All of those different things affected your premium. Same thing with house here. What affects your premium is what you have inside of it. So like guns and jewelry, musical instruments, antiques, anything that the insurance company has to pay extra for, that can affect your premium too. Okay, so let's get into these examples now and use everything we've talked about here. So the very first thing we're going to do here is our example 1 in your book. Okay, it has a homeowner here. We need to determine their annual premium for their house. It's a $150,000 house. It's made with brick veneer home. Okay, it is insured. The insured person has really good credit. He has superior credit rating. He wants a $250 deductible for the coverage, and he wants $300,000 liability. The contents inside the house includes $6,000 worth of jewelry. So to do this problem, we have to look at chart 406. So that needs to be right where you can flip back and forth and look at constantly while we do these problems. So the very first thing we're going to look at is just find our base price. Okay, so to find our base price, we need to look at the chart. And it says we have a $150,000 house. If you look in your chart on 11-1 there, it's that middle column here. It says that we have a brick veneer home. So we got to go down to the lower section where it says brick veneer, and we have superior credit rating. So if we look at that, we see that it's $445 for the annual premium. So that's our basic price. So that's our starting point. Now we're going to go ahead and we're going to find our additional cost here. It says here that we want $250 deductible. Now that is not your standard deductible, okay? And so your standard deductible is $500. So we're going to have to pay extra to have this lower deductible. And so if you look at adjustment number 1 in your book, right there, it says for a $250 deductible, add 25%. Well, that 25% is of your basic premium. So 25% I put as a decimal, 0.25, and I need to multiply it by $445. This gives me the additional cost. Every time I pay this premium, I have to pay an extra $111.25 for that lower deductible. Okay, the next thing we need to look at is cost for our liability. Here we figure that everything that we've included in our house is more than the standard $100,000 liability. So we want to have more coverage for it. So we want to pay extra. Now, because the standard is $100,000, we only are going to have to pay an extra $200,000. So if you notice in my figuring here, I have $200,000, not $300,000. I have $2,000 because the $1,000 is already included in there. Now, if I look at number 3, it says the base liability coverage is $100,000. Additional coverage costs 10 cents per 1,000. So here I have my 10 cents per 1,000. I'm going to multiply that by the 200,000 and I get $20. That's how much extra I'm going to pay for having that additional liability. Now, step 4 says find the cost of jewelry coverage. So for that, I have to go to adjustment number 4 in our chart below it. It says coverage for jewelry, watches, and furs is an additional $1.30 per $100 value. So my ratio here that I have, here's my $1.30 for every 100, and the value that the problem says for my jewelry is $6,000. So I'm going to go ahead and multiply that out, and I find that it's $78. So then the last step now is to take my basic price and add all of these extras in. This is my premium now for my insurance to get all of this coverage here that they want in the example. So we had to start with the basics straight from the chart, and then everything else came from those adjustments 1 through 5 below the chart. Okay, let's do another example that uses some different situations here. So let's look at this example here. You can follow along. It's an example on 407 in your book. Basically, we have Phil here. His annual owner's insurance premium is for a $200,000 wood-sided home. Okay, the house is on a coast subject to hurricanes there. Phil has a good credit rating and he wants $400,000 of liability. He wants $500 regular deductible and 2% for named storms. Find the annual premium and find what the insurance company will pay if Phil home needs $12,450 in damage repairs due to a hurricane named Aaron. Okay, so let's work our way through it. The very first thing that we need to do is find our base premium. Okay, so we got to go to our chart again. We know we have a $200,000 wood-sided home. And the next thing I need to know is what kind of credit rating he has, and it says he has good credit. So I go to my chart over here. Here's my $200,000 house. It's wood-sided, and I go down to where it says good, and this is $805. So that's my base premium. So I take this $805, that's a 5, guys, sorry. And now there's this 4 here. Where did this 4 come from? The 4 came from because of storms. If you look at adjustment 2 here in your book, It says for dwellings in coastal hurricane zones, the deductible for named storms will be 2% or 15% of the insured value. A 2% deductible policy has a rate 4 times higher than that on the table. So this is where the 4 came from. Because they live in a hurricane zone, I need to take their annual premium and multiply it by 4 times. This raises their standard basic insurance. I really hope they like living in that hurricane zone. They're paying for it. Okay, so now that we have their base price for living in the hurricane zone, now we go to step number 2. Step number 2 is we're taking more information here from our problem. And it says determine the cost of the increased liability. Now remember, our basic liability is $100,000. They want $400,000. So I end up taking $300,000 and I'm going to multiply it by that ratio of 10 cents for every 1,000. Now, here's a little shortcut for you. We have that nice little ratio, but we get tired of having to write it all out. Remember, when we multiply and divide, we can cancel out zeros here. So I'm canceling out these 3 zeros here and these 3 zeros here. So when I do my math, I only need to do 0.10 times 300. And that ends up with 30. Okay? So that's a shortcut for doing it. You might see it in your book, how they wrote the shortcut without explaining things. That's what they did, is they just canceled out the thousands here. And so they multiply 0.10 times 300. Okay, now let's keep going. Step 3 says now add them together. We've got our extra cost for liability and our standard deductible. Add them together to find what the annual premium is. Now we need to go ahead and take in and find what our deductible is. So this is what this family is paying. Now let's say they had the storm Erin come, okay? And they know that they have to make this amount of repairs done. Whenever you have repairs done, and file a claim with your insurance, you have to pay your deductible. So how much is their deductible? Well, remember in adjustment number 2 underneath the chart, it said that you had to pay 2% for every storm. So 2%, I put it as a decimal, and I multiply it by the cost of my home. Okay, so that goes right back up to our problem where it says I have a $200,000 wood-sided home. That's where the $200,000 is. Multiply that together, and that determines what my deductible is. So this family has a $4,000 deductible that they have to pay out of pocket before the insurance will make the $12,000 in repair. Now, the last part of the problem says, okay, how much does the insurance company have to pay? Well, to do that, we know we have the cost of the repairs, which is $12,450, and now I subtract the family's deductible. What's left over here, the $8,450, is what the insurance company pays. Okay, we're going to go ahead and do example 3 here, which is another example of loss. Here we have a $150,000 wood-sided home that is destroyed by fire, okay? We want to find out how much the insurance company is going to pay out for this family. They have a $1,000 deductible, and inside this house, and on top of their normal contents of goods inside their house, they had guns that were valued at $2,500 and some furs and jewelry that were valued at $5,680. So to do this, we need to go ahead and find out what the value of the stuff we had in the house. Now, if you look at adjustment number 5 at the very bottom of the chart there, of chart table 11.1, you'll find that it says that the contents of the homeowner's goods that are inside, so your clothing, your shoes, your computers, your PS4s, any game systems and clothing and all that other stuff, it has a worth to it. And the insurance company says that it is 70% of the cost of your home. And so we take that 70%, we're going to turn it as a decimal, and we're going to multiply it by the cost of that home. And the cost of the home, it was assessed at $150,000. Okay, we're going to go ahead and multiply that together, and we find that the insurance company is going to give us $105,000 for the goods that are inside of our house. Now, once we have that, we're going to go ahead and find out what the value of the extra goods are. And so we're going to add those together, and those extra goods were $8,180. And we're going to, next step is going to go ahead and combine them. Okay, we're going to combine those. So there's the 8,180 we just found. There's what the insurance is giving us for our goods. This 150,000 here, that's the value of our house. So we combine those three things together and we get the total of $263,180. That is what our whole house combined with the goods is what the insurance company is giving us for the value. Now, in our problem here, it says that we have $1,000 deductible. Before the insurance company gives us a check, we have to pay this deductible. And so we're going to go ahead and take this total here and subtract the $1,000 deductible. And this is actually the check that the insurance company is going to write to the homeowners to have them be able to rebuild their house. So this is why having insurance on a house is a good thing, because not everyone has $262,180 just sitting in their bank account to go ahead and rebuild a house if they have a fire. So insurance is a good thing. Okay, we're going to go ahead and we're going to do one more example here. And it's for this house that just caught on fire. Okay, we want to determine the annual insurance premium for this house in example 3 if it was insured at a good credit rating. Okay, so we're going to look at our different examples here. This is kind of like what we just did with example 1 here. So our goods, remember how we have our basic insurance premium and then we had to add all the extras to it? Well, remember this house had extra guns and had extra jewelry and furs that we have to take into account for. Now, if you notice here, I have 25 times 0.36. Where on earth did that total come from? Well, if you look at adjustment 4, it gives us a total that for 36 cents for every $100 value, we have to multiply for the value of our guns. And remember, our guns were worth $2,500. If I cancel these out, the $100, remember my two zeros, when they are on top and bottom, they cancel each other out. I can go ahead now, and this is where they get the 25 from. So 25 times the 36 cents gives me the value of $9. This is how much extra having those guns put to our homeowners insurance cost us. We're going to do the same thing here with our jewelry. Our jewelry cost is $1.30 for every 100 again. And our value, remember, our value for it was $5,680. Now, our zeros here, our 100, we're going to go ahead and divide by 100, which means I move my decimal 2 spots to the left. Okay, this is where they got the $1.30 multiplied by the 56.80. So our book does quick little things of canceling it out where we don't really know where that came from. This is how they did those numbers there. Okay, so now we go on to step 3. We're going to add these totals that we just got, added it to our base rate, and that base rate came from table 11.1. I had to go and find a $150,000 house that was under good standing. Come down my chart, there's 150. It was wood siding in 605. That is the basic rate. Add those together, and this is what my premium is for my insurance. Okay, now it says that we want a reduction for the higher deductible. Okay, this, remember in our example, they had a $1,000 deductible. That's not the norm. $500 is our norm. So because the family chose to have a higher deductible, they get actually a reduction for that. And if you look at problem number 3, it talks about, it would be number 1 right at the beginning. It says for that $1,000 deductible, we get to subtract 20%. So I'm taking 20% and I'm going to multiply it by the basic premium of the 605. 121 is what I get to deduct. So I take what my standard premium was here, the $687.84, and now I get to subtract that deduction for the higher premium. Sorry, the deduction. And now this is what my premium is that I would pay for having homeowner insurance for this house. Okay, guys, so your homework problem that you're going to get started on shortly here, you're going to have different problems that deal with all sets of these examples that we just went through. Read them very carefully, and you need to go back to the chart on page 406. 406 is your lifeline here. This is where you find your standard premiums, and then these adjustments are the ones that you're going to be working back and forth with. So read the examples carefully and follow through. If you have any questions, text or email me. Have a good day. Bye.